Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Sylvia Jablonski, Managing Director at Direxion Investments. Direxion is well known for its leveraged and adverse ETFs, and we are talking about some of the top performing leveraged ETFs today. Sylvia, welcome back on the program.
Hi, Nina. Thanks so much for having me.
Okay, so I wanted to start with the stock market. Stocks are trading close to their record highs, and the S&P 500 index is up about 23% this year. And in fact, past few days have been pretty good for stocks, and that's thanks mainly to optimism regarding U.S.-China trade talks and some better than expected economic reports. And the yield curve has uninverted, and so investors are now less fearful of an impending recession. So that has been very bullish for stocks. So what are your thoughts on the stock market performance so far, and can this rally continue?
So it's really interesting because I think, I felt pretty optimistic about the market for the last year or two, and I'm sort of not surprised. I am surprised at sort of how well it's been going this year. If you look at the market, all three major indices are up right now, which is probably unexpected. You've got Dow approaching 20%, S&P 22-ish, Russell 2000 goes to 18, and I think the issue is that a lot of investors for this year have been sitting on the sidelines because they were fearing a recession. There was a lot of uncertainty about geopolitical risk. There was a lot of uncertainty about China trade wars, about the Fed, whether or not the Fed would be supportive, sort of the battles between Trump and Powell. And, now we have investors on the sideline for another reasons, because the market did too well and valuations are too high, multiples are too high, and, we continue to see a lot of sectors shine. So it's been a really interesting year because I think that a lot of investors sort of were spooked by the idea that a recession was coming, and a lot of the reasons for the market fall that we've seen was attributed to that mindset. And unfortunately, they did miss out on the growth this year. But I think that effectively we've got companies, 70% or more companies beating earnings right now. Though it's a slowdown year over year, we've been beating, and there is some optimism now around China, and we've got the Fed supportive. So sort of those three questions that we said led to some fear and volatility have been at least look like they're being answered a little bit more optimistically, even if it's not clear that we will get a deal. I think the optimism around it has been pushing the market. GDP is outpacing expectations. Again, it's lower, but it's still positive. I think we're effectively growing, and I think that it bodes well for investors that are looking for opportunities in the stock market, at least in the short term, at least for the next 6 months or so.
Yeah, you mentioned some investors being on the sidelines. So I read a report in the Wall Street Journal recently that nervous investors have socked away $3.4 trillion in cash. So even if a little amount of that, little piece of that cash comes back into stocks, then this rally could definitely continue. And talking about earnings, as you mentioned, earnings have been better than expected. Of course, the year-over-year comparison doesn't look so good, and that is because 2018 earnings were boosted by tax cuts. So I would say that the earnings have been pretty decent this year as well. So it looks like the rally could continue.
Yeah, that's a great point.
Yeah.
That's a really great point that you make about investors who are also consumers. With all the cash on the sidelines, the consumer really has been driving the economy and the market this year too. So that's a great point and a big impetus for a rally to potentially continue if we get some of that cash back into the market and back into retail, real estate, and all the major sectors. It's a good bodes well for the market.
Right. Now, let's take a look at some of the ETFs that have absolutely crushed it this year. And the top performing ETF this year is the Direxion Homebuilders and Supplies Bull three times shares ETF with a great ticker symbol NAIL. It is up almost 180% this year. And of course, we know that home builders have rebounded strongly this year with falling mortgage rates, particularly earlier this year. And unemployment has been at record lows. Wages have been going up. So that is generally good for the housing markets and home builders. So tell us a little bit about this ETF's performance, and do you think this trend can continue?
Absolutely. So, why NAIL is doing so well is essentially that stocks, the home building related stocks, everything from supplies to build homes to homes, anything really related to real estate and homes themselves has been doing really well. And they're getting a lift basically from the ongoing robust housing sector activity. So you've got lower interest rates. You've got younger generations starting to buy. That was sort of frozen or non-existent for a long time. We saw a little bit of pickup there. But the big thing is really that the mortgage payments are lower due to interest rate cuts. And, when you've got a slightly slowing global economy and downward pressure on things like commodities, steel, aluminum, lumber, the things that you need to build a house are actually cheaper to buy right now, too. So you have this, this sort of perfect storm of lower mortgage rates, lower supplies. So whether you're, buying new construction or looking to build a house or to model, money's a lot cheaper than it was, just even about a year ago. So this ETF, which tracks, building related firms, is poised to do well. And I think that, as long as rates stay, where they are or go lower, which, the likelihood of at least a pause where we're at for some time seems to be the case from what we hear from, Fed Chair Powell, it would do quite well. This ETF would do quite well in that environment.
So, in fact, we have seen that rates have kind of inched up in the past few days, and mortgage rates have also gone up. So, do you think in this environment, the outperformance of the ETF can continue?
I think they've gone up, but not significantly so.
Right,
so I
right.
think if we stay in this, let's say, lower range, then I do think performance will continue. But if we see a rise in mortgage rates, then I would expect probably a little bit of a slowdown in house purchasing and things like that. But then, if you have a lot of new homes purchased, I still think that there's some room to run for some of these, lumber, steel related companies, even names like Home Depot, if investors have either refinanced or rates, they have more expendable cash, and that kind of goes back to the consumer. Does the consumer continue to remodel, rebuild, and whatnot? So I do think that there's some positive, potential for these names.
Yeah, and I think, yes, as you mentioned, because unemployment is so low, and as long as the labor market remains strong and wages, continue to rise, even if they are rising slowly, that is going to be good for the housing market. Now, let's take a look at the other ETF, which has done very well this year. It's the Direxion Semiconductor Bull ETF with the ticker symbol SOXL. It is up about 167% this year. And in fact, chip stocks, they have done very well this year, some of the chip stocks, but there has been a lot of volatility because these are companies that have a lot of exposure to China. So trade headwinds really affect these stocks because they have manufacturing and supply chain operations in China. And China is also one of the largest markets. So tell us about your thoughts on the semiconductor ETF.
Sure. So this is actually one of my favorite ETFs at Direxion, just because I think it's a very interesting trade, and I think it's it also feeds into millennial theme trading. But so SOXL is basically the 3-time semiconductor ETF, and what is in that ETF are names like AMD, Micron, Intel, Qualcomm, and these are companies that essentially provide chips They provide memory. They provide, research that leads to AI, software, various things. And they impact gaming. They impact AI in terms of like driverless cars. They impact, factories and robots and sensors that help increase technology in factories, especially where you have an aging population in places like Japan, so that you can, sort of lead to GDP. So I just think that this sector is poised to do well. We're getting some positive feedback out of Washington, again, on the trade war, which is the continued backdrop for tech and semi to grow. But I would say that, I agree with you that the headwind there is the uncertainty in that. However, if you look at what's going on in the background, the U.S. has started to move some of the manufacturing and some of the business to Vietnam, to Taiwan, to other countries. And I think that if we don't get a good solution, then we'll see maybe a pause in sort of the stellar performance that we've seen, just because companies will have to sort of reallocate, reshift, spend, and kind of figure it out. But I think that if we get positive news from Washington, and I sort of think that in the near term, some of these names could rally anyway, potentially because 5G is sort of the biggest thing right now.
Right,
so
right.
You've got names like Micron, for example. There's a continued growth in memory needs for 5G growth as well as gaming. 5G is 20 times faster, so you need sort of more. Qualcomm, if you get a deal with China, they were one of the massive top chip providers to Chinese companies. AMD, they have sort of a new smaller chip that did quite well and followed Intel's positive earnings, and we've basically seen a lot of these names basically rally through earnings season this year. And I just think that right now it's all sort of about 5G technology, software, cloud, AI, and SOXL. SOXL and the semiconductor names really feed into this. So yes, volatile, something to keep an eye on, but I do think the opportunity could still be there.
Okay, yes, I agree with you. Chip companies have so many growth areas. There's so much demand from areas like some of the areas that you mentioned: artificial intelligence, 5G, driverless cars, Internet of Things, cloud computing, and these areas are going to continue to grow in the coming years, and there would be demand for better and faster and more efficient chips. So definitely a very interesting area. Now, not focusing on chips, only talking about the broader technology, that ETF has also done very well. And in fact, I remember we talked about it last year too, when it was doing so well. And technology continues to be the top performing sector this year. It is up about 38% this year. And some of the tech giants, including Microsoft, Apple, they have done so well this year. So the Direxion Technology Bull ETF, ticker symbol TECL, that is also one of the top performers this year. Tell us, it is up about 128%. So tell us what you think about technology stocks and this ETF.
So I think it's a similar story to semiconductors. They're it's certainly related, and actually part of the semiconductor rally is attributed to some of the growth that we've seen in the tech ETF. As you said, it's up over 100%. This story, and you're right. The last time we talked about it, I think we were talking about a similar performance number,
Yes.
and this story has just continued to grow. And what you've got in that ETF is basically you've got Apple, you've got Microsoft, and those companies have really led that ETF, as well as a lot of the other smaller tech names. But there's some room to run. So if you just look at the Microsoft story this year, they won the $10 billion cloud computing contract with the Defense Department. That came after a strong recent news that they were going to have a $40 billion buyback, and they were going to increase the dividend to 11%, and just that they expected to have overall continued growth. Apple, people counting it out and saying that it's overvalued, and then here we are again. We just watched another $10 rally over the last few weeks, and that's really helped push the index up. And there you've got this captive audience of hundreds of millions of users, and Apple TV just launched this month with this all-star lineup. You've got sales of the new iPhone, which looked better than expected. It seems like a lot of people are buying that iPhone, and the growth in the services area as well. And then on top of that, I think, Google was a little light on earnings, but, basically 3 months ago, Alphabet, Google basically strong earnings, and you've got good ad sales there and revenue in YouTube that continues to grow. And I think that, investors will look to see how Google and other companies that are investing in cloud grow going forward. Again, looking at buybacks there, these companies have so much free cash flow, and they have these buybacks of 30, 40 billion. I think that pushes the stock price up as well. They're starting to pay like high and decent dividends, and where do you get that kind of income right now? It's certainly hard to in the fixed income market. Mm-hmm. So I do think that just, the interest in the dividend, and then, the sort of strong consumer continuing to buy the major names that move the index like Apple and Microsoft could sustain the rally that we've seen there.
Great points. Now, let's talk about the aerospace and defense sector and the ETF this year. The ticker symbol for this ETF is DFEN, and it is the Direxion Aerospace and Defense Bull 3 times ETF. It is up about 100% this year. And the performance of aerospace and defense sector and this ETF surprised me a little bit, because the index has a lot of allocation to Boeing, and we know that Boeing stock has been facing all those headwinds this year. But despite Boeing's poor performance, the broader sector continues to do well, and I think that's because of rising geopolitical uncertainty and increased military spending all over the world. So talk a little bit about this sector and the ETF.
Sure. So to your point, I think that geopolitical uncertainty and an uptick in military spending have really helped this sector perform this year. And a lot of the individual stocks, I think if you kind of take them one by one, you'd be surprised at their essentially stellar performance, and it sort of explains why the ETF has done well, even given the story about Boeing. So, Boeing, believe it or not, I was just looking at the index here. If I just run it from December 31st until November 5th, Boeing is actually, still up. It's still up about 11% or so, and it is a major name in the index, but it's not, it hasn't been dragging it down. So basically, while Boeing is a bigger overall company, one of the shining stars in the index that has, sort of a huge percentage is Lockheed Martin, mm-hmm. Which is one of the biggest defense contractors out there. They had about almost 15.2 billion in Q3 and about 50 billion in 2018. They have a market cap of over 100 billion. They have that F-35 Joint Strike Fighter. It's a key moneymaker for Lockheed. It's basically making it one of the biggest Pentagon programs ever. There's a lot of growth there, and when they came out in their call, they had said that management expects the program's revenue will go faster than the overall top line through the end of the next decade. Demand for new jets is also generally expected to rise as some of the old airplanes are retired over the next couple of years. If I just look at some of the names in that index that DFEN tracks three times the daily performance of, you've got Triumph Group is up over 98%. You've got Arconic 75% year to date, and then a lot of these names like Lockheed Martin, Mercury Systems, Hyco, Teledyne. Some of these names are up 40 to 60%. So to your point, all of it is essentially, or a lot of it is essentially going into aircraft carriers mm-hmm. and defense, and the larger part of it seems to be coming from military spending. So I think that, while the Boeing thing is definitely like a headwind, big headline risk and whatnot. But even there, they have one competitor, essentially one real competitor, which is Airbus. So mm-hmm. I think that, if they sort of, if they get this right, and there's a better story with the F-37s, then perhaps Boeing. I think Boeing's got to be pretty close to their all-time low. We'll see if that's right or not. But if that name sort of picks up and the military spending continues, and you have all these sort of older aircraft that need to be replaced, you might continue to see performance in that index.
So which areas of the market look attractive to you now? Should investors look at cyclical areas or more defensive areas of the market or underpriced areas which have been, ignored by the investors this year so far?
So I think in general, I would say that given, I probably sound pretty optimistic on this call, and I am, but I think that, with optimism comes, some caution. So I would encourage investors to diversify their portfolios. So yes, look at those, late cycle performers, look at some value names. I'm really interested in healthcare, biotech, and pharma right now. They've been absolutely clobbered for various reasons,
Right.
whether it's politics, opioid crisis, and they've just generally underperformed the S&P this year. But if you look at, some of the names in that index, you've got, like a single name like Medtronic, which is up over 20%. They basically create, tachycardia and arrhythmia types of pacemakers and things. You've got Merck, which has some strength coming out with Keytruda, HIV research. Basically, just sort of like pick one of the top names, Pfizer, Merck. They've got a pipeline of hundreds of drugs that are, coming out, and some of them are pretty far along with FDA approval. You've got 70 million baby boomers with consumption to come. They're essentially aging, and they'll consume on healthcare. Healthcare trades at a 15.1 times 12-month profit forecast. That's a lower multiple, basically, in every single sector out there besides financials. It feels like a lot of the political risks are priced in. The Medicare for All thing, it kind of seems like that's getting pushed aside a little bit. You've got mergers, reduction of costs, almost no impact from trade wars. And you've seen billions of dollars of outflow in healthcare just because it hasn't done as well as everything else. And I think that, if you look at healthcare and then you look at biotech in particular that has almost, very little exposure to politics and a strong pipeline of products, using ETFs for those sectors is super interesting. Again, investors are moving back into biotech and healthcare, I think, because you're seeing a lot of positive news about clinical trial results. It's a broader catch-up trade. And I think that, and then on top of that, some of these names, you've got Merck, you've got Pfizer, some of them, again, pay pretty decent dividends. So if you catch them on a low valuation, you get some income along the way, and you're patient. 70 million baby boomers aging to consume healthcare is a pretty big number. That's it's got to impact the sector at some point.
Mm-hmm. Okay, great points. And your healthcare bull 3 times ETF has a great ticker symbol, CURE. And there's pharma and medical bull ETF with another great ticker symbol, PILL, PILL. And then there's the biotech bull 3 times ETF with the ticker symbol LABU. Now, I also wanted to talk about how these ETFs are built and how they should be used in a portfolio, because I think this is one of the most misunderstood areas of the ETF market. So tell us a little bit about how these leverage and inverse ETFs work.
Sure. So basically, ETFs and Direxion ETFs are similar to all other ETFs in that they resemble mutual funds in their structure, but they can be traded throughout the day like stocks on a simple level. So what differs between Direxion and other ETFs is that we offer leverage in our ETFs. So basically, our ETFs are 3 times leveraged. Some of them are 1.35 leverage, some of them are 2 times leverage, but we're sort of best known for the ETFs that we talked about today. They're 3 beta funds. So they're daily trading tools, and they're basically designed to help increase exposure for investors so they can stay agile in the markets. And what that means is, if you have a short-term view and high conviction on a particular sector or index, the Direxion Daily ETF is designed to give you daily investment results before fees and expenses of 3 times the performance or the inverse performance in the case of a bear fund of the actual benchmark. So it's not, if the index is up 10% at the end of the month, that's not how you view this ETF. It may or may not be up 30%. It probably won't be. But if an index is up 10% in a day, you would expect a bull fund to be up 3 times that amount. So, they work really well. We say trend is your friend. When the market continues to sort of trickle upwards and volatility is low, compounding and the rebalance work in your favor. When you have any kind of range-bound volatility, that tends to decay the ETF. what I tell investors is these are great and powerful trading tools. Trading is the key word. So you can hold them for more than a day, but you should actively take a look at your account and make sure you have the same view on the direction of the index and also volatility, meaning you believe that an index is going to go up and you believe that volatility will be low. If you believe that an index will go up, but there might be range-bound volatility along the way, that is a time to trade for a day or intraday. If you believe that it will be sort of low volatility in a trend, that's where you can really benefit. So these ETFs that we've talked about today that have, 100% and higher returns, the reason that they've done so well is because those indices have been trending upwards basically for the whole year. Whereas if we talked about gold miners today, for example, like a Nugget or a Dust, those are highly volatile ETFs, and most sophisticated traders hold them for a day because they know that the volatility could quickly erode the earnings on either side, bull or bear. So, again, just powerful trading tools for investors who, can accept substantial losses in short periods of time, and they understand that levered ETFs do, really well in low volatile markets, and they have time to manage their positions and frequently adjust to changing market conditions of the funds.
Okay, those are great points, very helpful. It is very important for investors to remember daily rebalancing, and that trend is your friend. So if the market is trending, probably they will continue to do well, the ones that are doing well. But if the markets are volatile, then you should not expect to achieve 3 times the return of the index because it would go up and down. So that's all we have time for today. Sylvia, thanks again for joining us.
Thank you so much for having me.
Thanks for listening. If you want to learn more about these ETFs, please visit Direxion.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.